Hello, and today we are analyzing IDEX Corporation, ticker IEX. Over the next few minutes, I'll discuss my thoughts on both the valuation of this company and its business quality. The company has a market cap of $16.9 billion, enterprise value of $17.9 billion. You see about $1 billion in net debt on this business. They are operating in the machinery industry. So let's see here. They provide solutions worldwide. That doesn't mean anything. They have fluid and metering technologies, health and science technologies, and fire and safety diversified products. So they design, produce, distribute pumps, valves, small volume provers, flow meters, injectors. So that actually tells you a decent amount about kind of what they're doing. These are definitely moving stuff around, but these are, very technical machinery equipment, industries, food, chemical, general industrial, water, wastewater. They design, produce precision fluids. Here's some more pumps in this segment. So they're really producing pumps, valves, and control systems for various different segments, various different sectors. These seem like sectors that aren't necessarily very volatile. I mean, you're talking about food, chemical, general industrial, water, wastewater. These are high demand areas that are very stable, something like firefighting equipment, health and science. So it's not very that, but just basic machinery components. Beta 0.98, share turnover 191%. Neither one is that interesting here. We have return on invested capital. First thing we can see here, though, is you have 20 straight years of profits. And as soon as you have 20 straight years of profits, it immediately starts to think, hey, this is a high quality business because you've avoided losing money at all in the last 20 years. When you make a profit each and every year, that just raises the bar of your margin of safety. You know that you have some reliability there, that you're going to be able to predict in the future you're going to continue to do well. Likewise, one of the things I like to look at here is this 10% line on return on invested capital. So once I know I'm making a profit, how much profit am I making? It looks like from the 2000 to the 2011 period, they really struggled to stay above this 10% line. But since 2013, they've stayed above the 10% line very solidly. So the business has improved since that time. You're seeing 11%, 11%, 12, 11, 12, 14, 14, 11, 11, and 13. I don't mind a little bit of volatility in that range. The fact that you're simply sitting above a 10% very strongly and stably is a good sign for the overall quality of the business. And we see over the last 10 years, this return on invested capital of 12% average returns certainly meets my metric of 10% plus, and I would say it's a high quality business so far. The leverage that they have in the business is boosting that return on invested capital to 18.8% on the return on equity line, again meeting my 15% threshold. So overall, we could say, hey, this is a high quality stock, high quality business. I'm liking what I see there. Now, when it comes to valuation, we see PE of 28. You see a lot of high numbers here in the 20 to 30 range for EV to EBITDA, EV to free cash flow. And so you're instantly saying, hey, this is probably a pretty expensive business. The average S&P 500 company historically would trade at a PE of 15. We're almost double that at a PE of about 29. So you can just say, hey, this is trading at a very high price. Now, how do you deserve a high price? We know it's a high quality business, and high quality businesses would tend to trade a little bit higher premium. So instead of like a PE of 15, maybe we're interested at a PE of 20, but you're still above that by about 40%. So we're saying, okay, we're definitely paying a premium price for this business. Now, what could justify that? Unfortunately, the revenue is not growing very fast. Revenue is growing at 5%. This is what I would call solid. But with these sorts of return on invested capital numbers, return on equity numbers, and my target for 10% plus returns, we're looking for double-digit returns. I would love double-digit revenue. I don't need double-digit revenue growth, but I would like that. Now, what we would say is we need to go from 5% revenue growth and we need a boost somewhere else, and we're not really getting it. Now, we do see 32% EPS growth, but I don't think that's really reliable. You can clearly see that's not some sort of compounding effort. There's some one-time effects going on there, because in 2013, they had $3 in earnings per share. 2022, $7.71 per share. That is a little bit more than a doubling in a decade. Doubling in a decade would be about 7%. Per year, and we're seeing it's probably in the range of close to 10%, but it's not 10% EPS growth. It's certainly not 32% EPS growth with those sorts of numbers, and so you're really not hitting the massive amounts of numbers you'd want to see on this kind of growth rate that would justify a P here. So I'm going to say for now, this is probably overvalued. At a P here, you're talking about like a 3.5% type starting yield. And so 3.5% starting yield, 5% revenue growth. Maybe you're targeting maybe somewhere in that rate, 8.5% type return range instead of something a little bit higher. So I would like it to be higher. That's the main thing, but this is definitely high quality business. It's just a little bit expensive. Doesn't mean you can't buy it. Doesn't mean it can't be a good investment. Just something to be aware of. Now, this revenue we can see have gone from $2 billion to $3.1 billion. So about, again, 50 to 60% higher over the course of a decade. It's not a huge jump. This is a very stable, strong business. One of the things with high quality businesses, especially ones in the S&P 500, is they tend to be kind of maxed out. They have a certain amount of market share. You're not doing a lot of stealing market share from your competitors. You're able to just make solid profits, grow at a reliable rate. Maybe you're growing at GDP or a little bit faster than GDP, but you're not some massive growth company. That's certainly fine. You can do really well owning high quality businesses like this, but it's just something to be aware of, compared to maybe some faster growing companies. Gross profits seem to be hovering between 43% and 45%. Pretty stable. I've seen some more stable gross profit margins, but that level of stability and the lack of big cyclicality in this gross profit margin percentage is a key point that is, again, saying, hey, this is a high quality business, something to be aware of. Likely, one of the ways that we have been driving our revenue growth rates to be lower than our EPS growth rate, so the EPS is growing even faster, is you've increased your operating margin over time. This is a really good sign that the business is being managed quite well. You have this operating leverage because you've gone from 19.5% operating margin to a 24.3% operating margin. That's going to allow the EPS growth rate to grow substantially faster than the revenue growth rate because you're able to get some of that margin boost. Now, the problem is it's not something you can rely on to go into the future, because at some point your operating margin can't exceed your gross margin. Your gross margin can't exceed 100%. So you can't do this forever. It's just something that can help in a short-term period. It's why I don't really like to rely on operating leverage when I'm marking out what my future returns might be. But I would like to find companies that have operating leverage like this, because maybe it can continue for the next 5-10 years. And maybe I just hold the stock for those 5 to 10 years. I don't need to hold it forever. And so if you can hold it during a period of operating leverage, you can really accelerate your returns. Now, one of the things we need to take a look at, though, is not just earnings, but dividends, to get an idea of kind of like how much that's going to boost our return. You see the most recent dividend, $2.34. They've been growing their dividend every year. That's a very good sign in terms of capital allocation. $2.34, $222 stock price. So we're going to say the dividend's about 1%. That's really not going to help us too much, because when we're kind of like thinking about our returns in terms of valuation, a good metric you can use is kind of revenue plus dividend. And so if your revenue growth rate is 5% and your dividend is a 1% yield, 5% plus 1%, that's a 6% type return. So when we're thinking about this, like, okay, this is a high quality business, but maybe our returns that we would put a base expectation is somewhere in the 6% to 8.5% range. 8.5% being that, the optimistically we might do earnings yield plus revenue growth rate, but on the lower end we might say dividend yield plus revenue growth rate, and that kind of gives a good margin of 6 to 8.5%, what you might expect. So overall, that's really just kind of talking about, hey, this company is a little bit overvalued at lower prices. Both of those numbers would end up higher, and it becomes a lot more attractive. So if you're enjoying this video, hit that like button. Don't forget to subscribe. Let's go into the income statement next. Now, we talked about how our revenue is up, 60%. Gross profit is up a lot closer to something like 80%, and it looks like our operating profit has basically doubled. So again, that's your operating leverage, is as you go further down the income statement, you're getting better and better results. And part of that is, of course, you're maintaining your SG&A not going up as fast as your gross profit. Your cost of goods sold is not going up as fast as your revenue. And those two things kind of play in together very, very well. Now you're going to get an extra boost because, of course, in 2017, you have the Tax Cuts and Jobs Act. So despite the fact that you have now higher pre-tax income in these later years, you're paying a lower income tax because the corporate income tax is lower. That is going to boost your EPS growth rate as well. Another thing that is boosting it is we can see here that your shares diluted have declined over time from 82 million shares outstanding to 76 million shares outstanding. Now, this is not a full 10% decline, but maybe you can throw in an extra 0.5% to 1% per year boost in the EPS from share buybacks. Now, they have kind of fallen off in the last 3 or 4 years, so you would really need to be careful about rolling that out further in the future, but at least during the past you can see that they're not increasing the shares outstanding and they're kind of maintaining a stable number. Let's go to the balance sheet. One of the things that's really good here is when I'm looking at this balance sheet is you have a really low level of PP&E plus inventory. So if we look at PP&E plus inventory, we see $382 million and inventory is 471 million. So let's just round that up to say, what is this, about 800 million, 850 million. Go back to the income statement, and we can see, your operating profit's almost 800 million. So you have, an 80, 90, almost 100% type, return in terms of operating profit divided by your inventory plus PP&E. Now you have some other assets here, but a lot of them are goodwill, intangible assets. You have some cash and accounts receivable, but I'm not really counting those. Your big, costly assets are this inventory and PP&E, which you can't get rid of. And so it's nice to see those very strong returns on the underlying capital. This business is executing very well in terms of the core business. The only problem with this business, as far as I see, is lack of growth. They are growing at 5%, so they have growth, which is good because the growth at 5% is able to earn good, strong returns on capital. We're not seeing overall declining returns over time. We're seeing strong underlying returns. They're not retaining a lot of capital. They're able to return that to shareholders. We like to see that, but it is something to be aware of there. They have doubled their long-term debt, about $779 million to $1.4 billion. Not a huge deal there in terms of their overall balance sheet. And it just shows some of the leverage they're actually able to put in place because they have more debt here than they do their core operating assets. So they're really running this business on debt and not having to do a lot of equity. That's a good sign because it means that the business can run very, very well. Something else that I like seeing, actually, is you see this PP&E number, right? So this is your investment each and every year. 31 million, 47 million, 43 million, 38 million. What I compare that to is the depreciation numbers for the same years, 79 million, 77 million, 78 million, 87 million. So your depreciation is almost twice as much as your PP&E in some of these early years, and it stays higher than a lot of these numbers. Now, part of that is they're also doing acquisitions. Those acquisitions are having to be amortized as well. But it's just showing that the core reinvestment in the business is not very capital intensive. They're not having to dump a lot of cash back into this business, and they're able to spend that cash on stuff like buybacks, stuff like dividends. It is unfortunate that they have stock-based compensation here because I think this is probably the culprit for why these buybacks, which are taking place every year, are not actually leading to large declines in the share count. It is because probably they have this stock-based compensation, which is offsetting it. A little bit unfortunate. Without the stock-based compensation, the company's actual performance would probably be substantially higher if they were just paying their employees with cash there. So you can see the growing amount spent on the dividend. I like how I'm seeing that there. Overall, pretty strong company here. We have a strong, high-quality business, 20 straight years of profitability. They're growing stably at 5% while earning very good returns on invested capital, 12% and 18% return on equity. My only holdup here is two things. So it's a great business in terms of what we're seeing. I like the business. The growth is a little slow for me. So the growth at 5% is just below really where it would start to get interesting for me as a watch list stock. If this growth was 8% per year on a sustainable basis, I would be much more excited. And this company, even at these prices, would probably hit my watch list. With the growth at 5%, it's just below what I would consider enough to get me the double-digit returns that I want to see. If you enjoyed this video, if you learned something, hit that like button. Don't forget to subscribe. And you can check out all my watch list stocks at the playlist up above. And if you enjoyed this video in this software, quickfs.net, the link to this software is in the description below. You can get a free or paid account through my affiliate link. Great way to support the channel because I get a commission if you sign up through that link. Thank you for listening. And until next time, stop paying fees, start building wealth.